And we are live. How's it going, everyone? I have some very special guests with me today from the Credix protocol. For those who are unaware, Credix is bringing in a novel solution to lending and borrowing, but I'll save a lot of the descriptions for the experts themselves. Today we have Chime and Thomas. How's it going, guys?
Hi there. Hi, Greg. Very nice to meet you. Really good.
Yeah, it's amazing to have you guys on, and I loved kind of taking a quick dive into what you guys are building, and I'm looking to get some more on it. For any users who are just popping in, can you guys maybe give your roles at Credix and a brief boilerplate of yourselves? I know you guys have some pretty hefty experience that I think makes what you guys are building really exciting.
Thomas, go ahead.
Yeah, great. And so thank you very much, Greg and Solana News for having us. Really appreciate it. Really excited about it. I think as a team, we have been in the blockchain space and the crypto space for quite a long time. Over the last 4 or 5 years together, we worked at a company called Intellect.eu, where we actually started the blockchain and crypto team. And we did a lot of work trying to push blockchain and crypto within financial institutions. So actually globally, from the US to APAC and EU, we worked with big banks, asset managers, market operators, and stock exchanges. And at the same time, we saw the rise of crypto and the rise of DeFi, and built some products together with startups in that financial services industry. And I think it's really that background of product building, understanding deeply how financial markets and capital markets work, as well as the whole business compliance and regulatory aspect that we now all bring together in Credix. And then so for me personally, my background has always been in fintech, financial technology, spent some time private equity, banking, consulting, and super excited now to be in the crypto space.
And from my side, so my name is Chime Finizola. I'm half Brazilian, which will become more relevant later on in the discussion. I know Thomas and Maximo are third co-founder for 15 years almost already. We've been doing a lot of things together in the past, work together, as Thomas just mentioned. But always passionate about how finance can be rethought using new technologies. And that really brought me to also work on the first regulated ICO back in 2017 in Belgium. I worked on a paper on my master's degree on blockchain interoperability back then as well, and really started focusing at Intellect.eu on development in emerging markets, working on some B2B products as well in the blockchain and confidential computing space. And yeah, about 8 months ago, we decided to take this leap of faith and start this company together with the three of us on our own. And yeah, I'm taking up the Chief Growth Officer role responsibility, which is responsible for the onboarding and scouting of fintechs or borrowers in emerging markets, this while growing the community and the marketing side of it. So I'm super excited to be here with you and share this with Thomas.
No, yeah, that's amazing. And I really think what is notable here is, one, you guys have just been in the space for a long time. Like, you were even thinking about this stuff while you were still studying at school, which is amazing. You guys have seen the developments, really been able to get your hands dirty and understand what is going on. And I think what's even more notable is you guys know you have chemistry and can work well together. So I think this product that you guys are tackling is, you can't even argue that. Of course, it's innovative, but having the right team to execute it is super important. And it seems like you guys are on the right track. To segue directly into that, do you guys want to just give a brief overview, maybe the top end thesis of what the idea behind Credix is?
Yes, most definitely. So I think to begin, at the core, Credix is a DeFi protocol, and we're a credit marketplace for lending and borrowing. But not like many of those that you know today, like a Compound or an Aave. We have taken a bit of a different approach. And that different approach is built on the thesis that, first of all, we need to bridge DeFi with real-world assets, with a real-world economical activity. Secondly, we need to rethink the regulatory and compliance aspects of DeFi, looking into permission DeFi, KYC, AML, to bring on board the traditional financial institutions and the large the large hedge funds, family offices, and banks. And last but not least, I think we don't only want to use crypto to make money and generate money, but also to have a positive impact and to work towards financial inclusion. And so that is why we have decided to really work with three main stakeholders. And the first and most important stakeholder of our platform are our borrowers. And our borrowers of our platform are not individuals, it are not corporations or SMEs, but actually we work with other fintech companies, with non-bank loan originators in emerging markets. So why are we doing that? Why do we have that focus? Very important is, first of all, we were looking like, okay, let's distribute capital directly to the individual, directly to the SMEs. But for that, you would need an insane amount of capital, you would need credit risk scoring models, etc. And actually, those fintech companies that are today already in existence, they do that very, 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 very well. But they have a problem themselves. And that problem is they don't have access to the global debt capital markets. And that is what we find with DeFi. DeFi is super efficient in allocating capital and is growing capital more and more quickly. And that is where our second and our third stakeholder come in, our liquidity providers who supply capital to a pool, and our underwriters who do the due diligence and the analysis of the deals that come onto our platform, onto our protocol.
Yeah, that makes a ton of sense. And specifically, you guys are focusing on emerging markets. And can you maybe elaborate a little bit on the reason why this is so important for emerging markets to bridge this gap?
Yeah, I think one thing, I used to live in Brazil as well. And to give you an idea, for you to get a loan in Brazil, any type of loan, you're paying at least 40%. So that's 40 a year just to get some credit. And that can go up to 350 if you're paying with your credit card. So certain type of loans that we have here in Belgium or in Western countries in general don't even exist in Brazil. Like you're not able to get a loan for your home. It's really, really hard. And the fact that it's just so expensive is really a blocker for development, for even getting out of poverty. It's one of the essential pillars to really start a business and starting a new life, getting access to credit. And we've been learning a lot about it, speaking with a lot of people about it. And we see a huge boom in the last 3-4 years of fintechs that are really trying to rethink how to provide cheaper credit to these end users. And I think that's really very fascinating, but they have a big challenge. And that's what we're trying to solve with Credix. So I think, yeah, that's a financial inclusion part that we also strongly believe and think this global platform and movement of money globally is where we can make a change with the Credix platform.
Yeah, and that makes a ton of sense. And I think that's what is truly unique what's going on at Credix. You have these insane borrowing rates in some of these emerging markets, but then in Western countries, you have people that aren't willing to lend because yields on things like bonds are in the low zero, like around 0% floored. So there's this entire gap here where there's people who are looking for credit, but they're getting it at absurd rates. So it seems like Credix is going to be able to bridge this gap using DeFi, but then also incorporating some sort of bridge with traditional mechanisms. I'm curious, just in your documents, I think this is more just like a fun question. You guys coin it as DeFi 2.0. What is your guys' kind of outlook on that? I know it's been like a ton of craze lately, but I think there is some merit to what is going on here. While I typically don't like the term DeFi 2.0, what is sort of your guys' stance on it? Just like more of a fun question here.
Yeah, definitely. And I think, yeah, a lot of people would kill us for calling it DeFi 2.0. But I think the main difference is like what we saw in DeFi that was being built over the last 12 to 24 months was really the core infrastructure. We had built the automated market makers. We had the decentralized exchanges, the lending and borrowing protocols. And on top of that, a lot of people started building products for traders and also buy traders. And so a lot of it was derivative exchanges, options, looking into different financial products, staking, farming, pooling, and a lot of innovation came out of that. And what we believe that DeFi 2.0 of whatever you want to call it, open finance will do is bringing in, first of all, the masses. So the retail, the big retail that doesn't really care if it's built on blockchain or not, but they just want a more fair, transparent, open, and accessible financial system. And then bring in the institutions that can bring in those $1 trillion of value, but that will now have to adhere to the new rules of open finance, of decentralized finance.
Yeah, and I think a big thing that is understated is understanding that the average user doesn't care about complete decentralization. Also considering how hard that is, the average user wants something that is going to work, something that is fair. And I think that's where you guys are truly doing something unique, where you guys are utilizing the blockchain DeFi to bridge this gap while also still incorporating real world mechanisms, which allows you to offer very useful products while still keeping them transparent and fair, such as under collateralized lending, which we don't see quite really anywhere on the blockchain currently. So I think that's a really novel solution to kind of steer this and get a little bit more into depth. I know we touched on some basic things. How are you guys able to achieve stable yields and this idea of under collateralized lending? I'm sure it has to do something with the way you guys have borrows and everything set up. So I'll just let you guys kind of touch on that.
Yeah, I think so. First of all, everything that we do in our protocol today is being done in stable coins. More specifically, today we support USDC as a stable coin on Solana. So all of the yields that are being generated are directly on top of that stable coin. Now, why are the yields on top of that so stable? It is because with these fintech borrowers that we work, we actually provide them larger credit lines and long-term loan agreements. So for example, a fintech would come to our protocol and they would borrow between 1, 10, 15 to 20 million USDC, and they would pay a fixed interest rate per year for that. And we channel that back to our investors. So nothing of that is related to any crypto volatility because we use a stable coin and the actual borrower is distributing that in real world assets. And it's also those real world assets that are allowing us to not over collateralize on chain. And I think here is a bit of an important segue to take. Like, over collateralization by itself is not a problem. It has been done in financial services for years, and it protects the risk that investors take. The problem today with crypto borrowing and lending is that over collateralization has to happen in a specific crypto asset. And these real world borrowers, those fintechs, they don't own Bitcoin, but what they do own is they have a loan book. And so what we actually do is we take that loan book and we securitize that loan book as actual collateral so that there is still a claim of that. And by doing that, we can under collateralize on chain. So no need to put up crypto assets. Very shortly, I want to touch there also upon a dream and a vision that we have. And that is to bring all of that on chain as well. Actually bring the loans of those borrowers on the blockchain and then being able to use those real world assets as collateral to finance their credit lines, to finance their loans.
Awesome. And just to elaborate a little bit there, the real people who are taking these risks are the people who are not precisely the LP people, the people who are providing liquidity, and we'll get into that, but it's the actual who is taking the risk then in this under collateralized model? I guess that is the main question.
Yeah, so we split our investor base in two groups: underwriters and liquidity providers. Both of them take a certain amount of risk, but into a different level. The underwriters, that are the ones that invest on a deal-by-deal basis, they invest actually in the junior tranche, the first loss at risk capital. But for investing in that, for taking that extra risk, they get an extra reward. Of course, then you have the liquidity providers. They invest in the liquidity pool, which acts more like a fund. And by investing in that fund, they actually spread their risk. So they still have a risk, an asset performance and a counterparty risk. Of course, they get rewarded in interest rates for that, but it's much smaller as that what the underwriters take. Very shortly, we have a very comprehensive risk management framework for that. So very important is, first of all, we over-collateralize off-chain. So if a borrower wants to borrow 1 million, they might have to put up 1.5 million in loan assets. And then there is an excess spread. So for example, we would charge the borrower 15% for that credit line, but they would lend it out in the local market still for 25 to 30%. So there is some extra coverage there. And by using underwriters, liquidity providers, and those mechanisms, we are very, very, very protected. But then also we don't just work with any borrower, and maybe Shane, you can elaborate a bit on that as well.
Yeah, for sure. So I think it's quite important that when you look into these markets, just in Brazil, there are over 200 credit fintechs. So it's booming really fast. And there are a lot of different tiers in this kind of credit fintech. So we have the really large ones that are doing hundreds of millions of dollars every year in loans. And those are actually the ones that initially we're not targeting. So those are the ones that have ways of creating structures that can get investments from the Goldman Sachs, from the cities in the world. And it starts becoming interesting for these huge institutional players to invest in these. But everything below kind of 100 million, that's not really interesting for these huge players. In the future, we aim to speak with these larger fintechs as well. But for now, we're focusing on the tier 2 and the tier 3 fintechs. So those are not the ones that just started. We're really focusing on those who have a credit history of their clients, who have, for example, raised the first seed round, have a strategic advisor on board with whom we can talk to, have already been operational for at least a year, know their market. We do the due diligence by also speaking with the entire team behind the fintechs. And by having relationships in these markets and understanding the companies and the structures and their partners really well, we're really focusing on doing really good due diligence initially before we bring those different fintechs on board. I think that's quite key in understanding the market, understanding the culture, understanding the people, and also one of the reasons why we need to be actively with local footprint to speak to those face-to-face, eye in eye, and get them on board. And only if we really if they're going through the entire due diligence, when we look into their credit history, when we look into their profit rate, when we look into the documentation that they are required to provide to us, later on is also provided to the underwriters, obviously after the right paperwork and NDAs. That's only the moment that we really onboard this high quality fintechs to our platform.
Yeah, and that makes a lot of sense. Just to maybe try to break it down a little bit, these fintech and non-bank loan, what would be the term for that? They're
non-bank loan originators.
Perfect. Yes, non-bank loan originators. This is the demand on the borrowing side, and it seems like you guys have a fairly great way of evaluating whether they are stable or not, and they already have good systems in place. An issue they're having is just finding some of this capital. So on the other end, how are you guys getting people to underwrite loans to the borrowers? And in my understanding, these are done in a little bit on-chain, but there's also an off-chain contract, and that's what really kind of makes it more secure and allows for all of this to happen.
Yeah, exactly. So what actually happens is when a deal goes live, so a fintech company comes to our platform, to our protocol. They will have to pass a first due diligence test by Credix. And after that, they can actually present the terms of the deal to our underwriters. At this stage, our underwriters have a certain period of time to underwrite the deal. The deal will be the junior tranche, which more or less is almost 20% of the total deal. So if this borrower is looking for 1 million USDC, 200K of that needs to be underwritten by the underwriters. How do they underwrite? They get access to all the due diligence materials. And once they feel comfortable, they can supply USDC to the junior tranche to that smart contract. So that happens on chain. Once the junior tranche is fully filled, then the senior tranche goes live in the liquidity pool and is filled with capital. And now the borrower can withdraw the USDC and start using that for real world asset lending. Important, what has happened here as well, in the background, there has been an off-chain contract between the underwriters and the liquidity providers and the borrower so that they can claim the actual assets, the actual collateral. There also, we are looking to streamline that, to standardize that, and to scale that, and to bring as much as possible on-chain, of course.
Yeah. And that, I think a really big thing to touch on here is maybe what is the difference between an underwriter and an LP? Someone like myself is going to be much more likely to be a liquidity provider just because of the thresholds, the risk. And can you maybe elaborate on the differences, maybe why, or yeah, we'll just kind of leave that there, outline the differences of an underwriter and an LP.
Yeah, so I think one of the main reasons why we actually also started Credix is because we felt that private credit in the credit markets was an investment opportunity that today was only accessible for the very rich and not for every retail investor. And that's why we say, like, look, we want to have this liquidity pool, and the liquidity pool that there, everybody, you, me, everybody on this podcast needs to be able to supply one USDC and start getting exposure to that and getting nice and interesting yields. So that are the LPs, everybody. But then we say, like, look, if we decentralize this protocol, it cannot be Credix that does all the due diligence and that chooses who gets capital from the pool or not. So we said, like, okay, let's look at the community to do the analysis. And then very quickly we realized, like, okay, actually who is best positioned to do this analysis? And that is still the financial institutions, the accredited, the qualified investors that we have today. And so that is why the underwriters, the one that do the grind work, the due diligence, that go into the financials, the balance sheet, the historical loan books, those are hedge funds, family offices, banks that have been doing those kind of analyses for years. And that gives you, as a liquidity provider, the trust that those deals have been analyzed, and more important, that those institutions have put their money where their mouth is, because they can only underwrite a deal by supplying capital to the junior tranche.
Yeah. Okay. That makes a lot of sense. And I guess my next question here is, how are you guys looking to attract these underwriters? I mean, the easy answer might just be the yield is kind of attractive. And I guess the follow-up on that have you guys already seen demand from underwriters who would be interested in utilizing Credix?
Yeah, definitely. So I think from the underwriter perspective, we have a phased approach there. So our first focus is, we say, like, look, we focus on financial institutions that are already involved with crypto or already involved with private credit. So these are mostly hedge funds and some innovative family offices. We actually have now the first ones onboarded into our platform that will support us in the go live. After that, we will be looking in more traditional private equity and asset management to get them on board as well.
Awesome. And I think sort of before I move forward a little bit more, I want to touch on maybe just some risks, but I think overall it's really unique how you guys are able to almost democratize this process more. You guys still understand that these people who have been doing it for years, they have valuable knowledge and it's important to loop them in, but you're also creating this other aspect where someone like myself, a liquidity provider, can still earn a much more handsome interest rate than something like bonds here in the US for myself. So I think that's incredibly important. To just touch on some more things, I'm curious, what does the process look like when a borrower defaults? How does it look for the underwriter with their off-chain contract? What does that look like? And then on-chain for the LP specifically, how are they affected?
Yeah, it's obviously quite interesting. On one hand, we have this off-chain over collateralization, and our investors will always have first access to this over collateralization when they default. Now, if they really default and we're not able to access those assets anymore, then it's really these underwriters that in a junior tranche are taking the first lost capital, because they are getting higher yields in return. They've done the due diligence. They are also going to be the first ones that are going to miss out if anything really goes south with this fintechs. And then only if the 20% of the deal that is the junior tranche is all can be paid back, only then the liquidity providers will be affected by this default. But they're also there, given that we are onboarding all these different fintechs with all the different credit lines, the risk is also spread for liquidity providers over all the different credit lines that are on the platform. So also there, it's quite limited what the impact would be for the LPs. But obviously, those are the worst case scenarios.
Yeah. And that makes a lot of sense there. I know we've touched a bit on the junior and senior tranche. Do you want to maybe just try to elaborate on that a little bit more for anyone who may be confused? Because I know the first time I read it, I was like, oh, tranche, like what is going on? But it makes sense how you guys have it set up. And I think you've already done a good job of outlining it, but maybe just touch on it again for anyone who isn't 100% on them.
Yeah, so I think the junior tranche is when a borrower comes with the credit line, let's say $10 million, they need it in 1 month. They will subscribe it to the platform. They will go to diligence. We will do the assessment initially, and then the underwriters, the high net worth individuals, private equity firms, and so forth, they will get first access to all the documentation that's required for them to do the analysis on that specific credit deal, and they will be able to subscribe up to 20% of that specific credit deal. So in the example of 10 million, they can subscribe up to 2 million in that 10 million deal. Once that is fully backed, so it can be more than one investor, right? It can be 10, 20 underwriters investing in that specific junior tranche. Only after that's really funded, then the remaining 80% comes in our liquidity pool, and then automatically it will be funded by the liquidity pool, so that the risk is spread over all these different 80% senior tranches on the platform. So the junior tranche is the underwriters specifically that are investing for a fixed amount of period in the junior tranche. They're getting a higher reward and get access first to do the due diligence and need to fund it first. Only once that is funded, the remaining 80% arrives in the liquidity pool and will automatically be funded. And then the liquidity providers can get in and can get out of this liquidity pool much easier, whilst the underwriters have this fixed term that they are required to stay in there. So it's an NFT kind of representation that they get in a junior tranche. The senior tranche is a fungible token.
And I think if I can maybe add to that, because it's not a concept that we have invented. It's a concept that has been in traditional finance for years. It's AB tranches, ABC tranches, junior, senior tranches has been there for a long time. And the beauty of the system is actually that you say, like, look, if you take more risk, you get more reward. And you do that by leveraging a part of the tranche, the lower tranche, that doesn't want to take that risk and is happier with a lower yield. And by that, you can create some very interesting mechanics. And because we are now working with smart contracts, with those Lego blocks of DeFi, it makes a lot of sense to implement that with indeed the mechanisms that Shine just explained.
Yeah, and that makes a lot of sense. And also in the junior tranche, that's also another way of having this due diligence check. As some people may think like, oh man, why do the traditional investors, the private equity, why do they get to go in first? They're taking bigger risk. But myself personally, like if I look at this, I'm not going to be able to evaluate the credit of something like a fintech or a non-bank loan originator. I'm just not personally going to be able to do that. So I definitely like how it has this twofold process here. And then, yeah, someone like myself with the LP, it creates great flexibility for me to be able to have liquidity and withdraw my capital when I want. So I think that's definitely super unique there. I have a few more questions, but I'm starting to get down to the end. So if anyone in chat wants to pop anything up, I'll filter through those at the end. But I'm curious in the sense of, if I am the LP, you guys do have something that we didn't quite touch on. You have this reserve pool. So even if there is no borrowers, there's not enough demand, you guys are still utilizing this capital elsewhere. Maybe elaborate on that a little bit, and then I'll get into my next question, just so we can go step by step here.
Yeah, sure. I think we've been thinking a lot about how can we make this process of funding these deals as smooth as possible, and also how can we make it possible for people to get in and out of the liquidity pool the easiest way, but also how can we make sure that even the liquidity providers are getting a decent yield, because if we keep growing the liquidity pool, at some point, some capital is not going to be reused or going to be live use for the specific credit lines, and the yield would start going down. So we came with this new innovative concept that is the reserve pool, which is kind of a first in, first out queue mechanism system where you can deposit your USDC, and the longer you stay in, from the moment a new credit line is added to the liquidity pool or to the platform, then the first money that's has been the longest in the queue will automatically be used to fund this credit deal. But as well, the moment that you have a liquidity provider that's looking to get out of this credit deal, we are able to do a switch with the people that are queuing so that they can get access to this liquidity pool. And then the capital that's really in this queue, that there we're using, and we're working with these different Lego blocks, again, is DeFi ecosystem, which is so amazing about it, that we really can allocate this capital and make sure that it's getting yield in other protocols, as long as it's actually waiting to get in our liquidity pool. And I think all credits and merit to our CTO as well to think out how this works, and some of the amazing community that's helping us with designing this. But that's really a very innovative thing that we're looking to bring into not only Solana ecosystem, but I think DeFi in general. And we're looking to publish much more on that soon.
Awesome. Yeah. And then my next question, to kind of build on that, in the situation that there is no reserve capital, this would just be like any traditional DeFi lending and borrowing. Unfortunately, you would not be able to withdraw until more capital flows in. Correct me if I'm wrong there, but do you guys have like some sort of ideas? Like, obviously, if this was an issue, you could introduce some sort of incentivization to increase that reserve pool. Is that something you guys are thinking about potentially, if needed, to boost these yields with some sort of Credix token incentive down the line? I know the main idea is to keep them stable, but is that a thought you guys have had if needed?
Yeah, so I think first of all, what we are doing is we are indeed building a lot of bridges and integrations. We are speaking with DAO treasuries, we're speaking with other protocols to channel TVL. So there is a lot of collaboration there on the composability of DeFi. And then I think definitely, I saw the when token question like very smoothly came in there as well. So there might one day be a Credix token. If we issue that token, it's going to be really a utility token and governance token that can help us and support us to decentralize us as a company, as an infrastructure, as a protocol. And then definitely liquidity mining and rewards will be included in the token economics.
Awesome. Yeah, that makes a lot of sense. I was just curious there. And I think a big thing, as long as the yields are attractive, that issue doesn't really surface itself. And it sounds like you guys are looking to make sure there's demand sort of on all sides here. And it looks like Kyle actually has a question here regarding the demand. You guys have spoken on a bunch of different countries. Is it a hurdle for attracting these underwriters in Western markets? It sounds like you guys said you already had some on board to address that, but maybe if you want to elaborate more, if there's any specific strategies for getting underwriters.
So I think, yeah, it's definitely a challenge, because I think so the underwriters that we today work with are really more crypto native. They're really innovative ones. Why did we choose emerging markets? Also, like crypto native funds and crypto native people, they dare to take some risk. They're used to risk. They know risk, yield, and the appetite. It's almost like the basics of how they invest and how they look at projects. It's also if they have to use USDC, a wallet, a custodian, nothing is new there. At the same time, we are starting our educational process. These private equity companies, those asset managers, those guys are still faxing with each other, right? So they are not going to invest in our protocol tomorrow, but we believe they have to change, they have to go with the flow. And so that is why today we start onboarding them step by step, and very, very, very educational driven.
Yeah, that makes a lot of sense. I like that little facts dig you threw in there, but it definitely seems like you guys are on the right track there. I don't have too many other questions. Is there anything exciting maybe you guys want to add on before I go ahead and wrap this up?
I think it's just worth mentioning that it's just a huge market. Like just in Brazil alone, those fintechs are already doing $3 billion a year, and it's growing 300 to 400% a year. So it's a huge market that we're tapping in, and it's not only in Brazil. It's the same in other Latin American countries like Mexico, Argentina. We're speaking with a lot of fintechs in Colombia and Peru as well. But we're super excited about Southeast Asia as well, and in Africa. So the credit market is just so big, and we're really looking forward in rethinking how this works. And I think the entire legal structure that we came up with the law firms we're working with to make it scalable to work in different jurisdictions, it's also something that's quite key to our product. So we're really excited and working with the community and working with all the different parties in making this work. And I think in January, you'll see we're going to launch this alpha version where we're going to already be writing out some credit to 4 fintechs initially, and we're going to grow that very fast the next weeks, as we already have a lot of borrowers in the pipeline that are actually just waiting for them to get allocated this capital. So if there's any underwriter, high net worth individual interested in participating, I think reach out to us, go to our website, credix.finance. And we're looking to open liquidity pool very soon for any other investors. So yeah, super hyped, and we'll definitely keep you posted on this, Greg.
Yeah, thank you guys so much, Chaim and Thomas. It was amazing having you guys on. It's really notable what you guys are building, and it's really only the beginnings. It sounds like you guys have everything mapped out. You guys have already gotten some recognition from the Solana hackathon. So it definitely seems like you guys have everything in order and are kind of just ready to get to launch here. I'm going to go ahead and kick you guys off here, do my little YouTuber outro. But thank you guys so much for joining us. We'll definitely stay in contact. I definitely want to have you guys back on when that alpha launch comes out to maybe outline what everyone wants to know, what the yields are looking like, but just even what the process is and what you guys have learned from going live. And so definitely really excited to see that. And I'm sure you guys can't wait either.
No, most definitely. Thank you very much, Greg.
For sure. Yep. Good to come back.
Yep. Thank you guys so much. Awesome, guys. So that was an amazing live stream. Chaim and Thomas joined us from Credix, and they had some incredible insight. I think the most noteworthy things is the fact that they are bridging a service that is fundamentally needed. You have many Western countries, as they've pointed out, with incredibly low yields in credit markets. And then on the inverse, emerging markets, fintechs are having to pay upwards of 100 or around 40% interest, I think was the number Chaim threw out there. So being able to bridge this through DeFi and kind of have this CeFi, DeFi mix, DeFi 2.0, whatever you want to call it, with these loan underwriters and finding a way to spread it out, incorporate DeFi mechanics is incredibly interesting. I think something that is also very notable is just the team's background and their knowledge in blockchain and traditional finance. So it seems like they're definitely on the right track and looking to build something innovative. For everyone watching, please go ahead and subscribe to our channel. Turn on notifications as well, like the video. We've been doing tons of content like this. We have interviews with a bunch of Solana projects, even more BSC projects, and we're only looking to get started. I'm going to be putting out some individual content pieces in the future, and there's overall just a lot of DeFi content coming out, and we're just getting started. So again, guys, please go ahead and like the video if you enjoyed Credix. It'll let us know that you guys want Chime and Thomas back on. Overall, thanks everyone for tuning in.